Hello everyone. Now let's continue our discussion about receivables, and now we're going to focus on note receivable. A note has some advantages over accounts receivable, and the main advantage is that it's a documented agreement, unlike accounts receivable, which is just verbal or oral agreement. So by signing a note, the debtor recognizes the debt and agrees to pay it according to its terms. So a note is a stronger legal claim. So if you're in court, you have something that's documented, would make it a stronger legal document compared to just having a verbal agreement that you have to prove it one way or another. So a promissory note is a written promise to pay the face amount, usually with interest on demand or at a date in the future. This is another term for what we call it notes receivable. So how we record it in the accounting records, we call it notes receivable, but from a legal term we call it promissory note. So what are the characteristics of the promissory note? There should be a maker, who's the party making the promise to pay. In other words, the maker is the person who is signing this note. The PE is the party to whom the note is payable, so the beneficiary or the person who's going to benefit out of this note. And we have the face amount, which is the amount of which the note is written on its face. So let's say it's $1,000, then we call the $1,000 the face amount. The issuance date is the date the note is issued and signed. The due date or maturity date is the date the note is to be paid. And the term of the note is the length of the period between the issuance and the due date. The interest rate is the rate of interest that must be paid on the face amount of the term of the note. And one thing I want you to remember, the interest rate that's mentioned or stated on the note is always, always, always an annual rate. So if the note is only good for 90 days and the interest is 10%, that doesn't mean that it's going to pay 10% for the 90 days. No, it's 10% for the year, and you have to multiply it by a fraction, which is the 90 divided by 360, or 3 months out of 12 months. So the interest rate that is stated on the note is always, always an annual rate that needs to be adjusted. And here we have an example of the note. So as you can see here, the number 1 is the maker or the person who signs the note. Number 2 is the PE or the beneficiary, per land company. Number 3 is the face amount, and usually it's written in numbers and also in words. And if these are not matching in court, they go with what's written on in words, in writing, not the numbers. So let's say we recorded here 200, but we wrote 2,000. So in court, this is going to be a note for 2,000. The issuance date is usually at the top. The due date is here at the bottom. And the term is 90 days, which is between March and June. And then the last thing is the interest rate, and in this case it's given here as 10%. And again, remember, this is an annual rate. So how we can determine the due date of a promissory note? As you can see here, this was issued on March 16 and the due date was June 14th, and we know it's for 90 days. How can we calculate the due date? So if the due date is not, we want to know it, because usually that's the unknown, and we know that it's going to be good for 90 days. We see how many days are left in the month of March. So this was issued March 16, so we have 15 days until March 31st. And always remember, January, March, May, July, August, October, and December, these are 31 days. February, it's 28 or 29 days, depending if it's a leap year or not. And then April, June, September, and November are only 30 days. So make sure that you're aware of this. I think it's not easy. It's not too difficult. I think it's easy. You can use the knuckle streak where you do January, February, March, April, May, June, July, and then you start over again August, September, October, November, December. So if it's on the knuckle, it's 31. If it's between the knuckles, it's 30 days. except for February, of course. So for March here, we have 15 days left, and then April, it's one of those, January, February, March, April, it's between the knuckles, so it's only 30 days. So we add 30, that makes it 45 days. And then May, we have 31 days. So the total now would be 76. And we need 14 days out of June to make it 90. So that would make it June 14th. So what are the characteristics of the note receivable? Again, to calculate the interest on the note, you have to get the face amount, which is the $2,000, multiplied by the annual interest rate, which is the 10%, multiplied by the term. So it's the 90 divided by 360 days. And again, we usually round it to 360 days to simplify it. If we want to be more specific, we can go with 365, but for the purpose of this course, we're just going to round it to 360 days. So that would be $50 in interest. So the interest rate is stated on an annual rate, yearly basis, while the term is expressed as days. To simplify, 360 days per year will be used. In practice, companies such as banks and mortgage companies use the exact number of days in a year, which is the 365 days, as I mentioned. So the maturity value is the amount that must be paid at the due date of the note, which is the sum of the face amount, which is the $2,000, and the interest, which is the $50. So let's see the journal entries for a promissory note. So a promissory note may be received by a company from a customer to replace an account receivable. So let's start with this kind of scenario. So assume that a company accepts a 30-day 12% note dated November 21st in settlement of the company or settlement of an account of WA Bond Company, which is past due and has a balance of $6,000. The company journalizes the receipt of the note as follows. We want to get rid of the accounts receivable, so we're going to credit the accounts receivable and replace it with note receivable for WA Bond Company. So we debit notes receivable and we credit the accounts receivable. The accounts receivable are not paid, but they have been replaced with the notes, and that's why we're crediting the accounts receivable and we're debiting the notes receivable. Both of these are assets, and that's why they are under the asset side of the accounting equation. And again, we're only recording the $6,000. We don't need to worry about the interest rate for now. The interest rate is at the time when this has to be paid. So at the due date, the company journalizes the receipt of $6,060. And we'll see how we get the $60, which is the interest. It's the $6,000 multiplied by 12%, multiplied by 30 days divided by 360, and that would be $60. So the total value is $6,060. That's the amount of cash received on the maturity date, which is December 21st. And then we are going to get rid of the note by crediting the notes receivable for $6,000. And then the interest revenue, and remember, revenues are always on the credit side, so we are going to credit the interest revenue for $60. And now we have, on the accounting equation, you can see that cash went up by $6,060, and the notes receivable went down by $6,000 on the credit side, and we have interest revenue, which has a positive impact on stakeholders' equity, or stockholders' equity, which is credited by $60. So if the maker of a note fails to pay the note on the due date, the note is dishonored note receivable and will convert it back to accounts receivable. So a company that holds a dishonored note transfers the face amount of the note plus any interest due back to an accounts receivable account. So assume that the $6,000 30 days 12% note receivable from WA Bond Company and recorded on November 21st is dishonored. So in this case, the company holding the note transfers the note back to the customer accounts, and on top of that, we also need to add the interest now. So we're going to cancel the notes receivable, the $6,000. We still need to record the interest revenue, the $60. The total of that would be converted to accounts receivable, so we're going to debit accounts receivable for $6,060. So again, this is another assumption that contradicts the previous one. The previous one here, we assume that they paid in cash the amount of the note plus the interest. But what if they didn't pay? Then we bring it back to accounts receivable. And then later on, if they don't pay at all, then we're going to write off the whole value, including the interest. So a company receiving a note should record an adjusting entry for any accrued interest at the end of the period. And that's another issue sometimes when that happens if we have a note that was issued in one period, but the maturity date is in a different period. So on December 31st, we need to make an adjusting entry to recognize the revenue earned during the current period. So assume that Crawford Company issues a 4,090-day 12% note dated December 1st, year 3, to settle its accounts receivable. If the accounting period ends on December 31st, year 3, the company receiving the note will journalize the following entries. So on December 31st, we're going to debit notes receivable, and we credit accounts receivable for 4,000. This is the first thing when we converted the accounts receivable into notes receivable. On December 31st, we need to recognize the revenue, the interest revenue, for the month of December. So we take the 4,000 multiplied by 12%, multiplied by 30 divided by 360. So we're going to debit interest receivable and credit interest revenue. Why didn't we debit cash? Because we haven't received the interest yet. This is just an adjusting entry. It's recognized the interest revenue, but it's accrued. It wasn't paid by the note issuer. So we have to wait until the maturity date, which is after, should be on March 1st. So the receipt of the maturity value of the note on its due date, which is March 1st, year 4, is going to look as follows. So we're going to collect cash of $41.20, and then we're going to cancel the note receivable for $4,000. We're going to calculate the interest revenue, which is $80 for the 2 months of year 4, which is January and February. And then the interest receivable from the month of December is also going to be canceled on the credit side for $40. So if you think about it, we have to calculate the amount of interest for 3 months. The month of December and then 2 months of January and February. The month of December belongs to the previous period, and that's why we had the interest receivable, and we're going to get rid of that. So we're going to credit the interest receivable, and then we're going to recognize the interest revenue for the current period, which is the value of the 2 months of January and February. So for the total of 3 months, it's going to be 4,000 multiplied by 12% multiplied by 90 divided by 360. So the interest revenue account is closed at the end of each accounting period, and the amount of interest revenue is normally reported in the other revenue and expense, which section of the income statement. So this is where the interest revenue would belong. So now let's see how the receivables are going to be presented on the balance sheet. So all receivables that are expected to be realized in cash within a year are reported in the current assets section of the balance sheet. Current assets are normally reported in the order of the liquidity, beginning with cash and cash equivalent, and then we go with all the other current assets. So you see here we have cash and cash equivalent, and then we have accounts receivable net value, which means that this is the net realizable value of 708. And then in the footnote, we explain the allowance for doubtful accounts. So the company makes ongoing estimates relating to the collectability of accounts receivable and maintains an allowance for estimated losses resulting from the inability of our customers to make required payments. So as of December 31st, the allowance for doubtful accounts was $15.1 million. So we provided this information in the note, but it wasn't provided in the body of the statement itself. So a company may choose to subtract the allowance for doubtful account from accounts receivable on the balance sheet to report the net realizable value of receivables. And I think in this case, the balance sheet would be more informative. Other disclosures, such as unusual credit risk within the receivables, are reported in the financial statements, footnotes, or simply the notes. Sometimes we call it the disclosures. Now let's talk about the last part in this chapter, which is analyzing for decision making. And here we have a couple of ratios that I think are interesting to learn. One is called accounts receivable turnover, and the other one is days sales and receivables. So the first one, it just shows like how many times within a period accounts receivables are issued and then collected from the customers. And then the days sales and receivables is like how many days it takes to collect accounts receivable. So two financial measures that are useful in evaluating efficiency in collecting receivables are these two measures. Let's start with the first one, which is the accounts receivable turnover. It measures how frequently during the year the accounts receivable are being converted to cash. And it's simply calculated as sales divided by average accounts receivable. Sales is an account that we see in the income statement. Accounts receivable is an account that appears on the balance sheet. When we see the word average, please remember that. We get the beginning of the year plus ending of the year divided by 2. And what is the beginning of the year? That's the ending of last year. So basically we get ending of last year plus ending of the current year, dividing them by 2, and that's how we get the average. So let's see an example. The average accounts receivable can be determined, as I mentioned, by getting the beginning and ending accounts receivable by dividing by 2. So in this example we have Under Armour Incorporated, and we have year 1 and year 2 sales, and then their beginning and ending accounts receivable. And you can see that end of year 1 is the same as beginning of year 2. So end of year 1 is the same as beginning of year 2. So what we're going to do is that for year 1 we're going to get the amount of sales, which is 5193, and we divide it by the average accounts receivable, which is the 610 plus 653 divided by 2, and that would be 63 or 631.5. We take these two values, divide them by each other, and that would get 8.2. So every year accounts receivables are issued and collected or converted to cash 8.2 times. In year 2, it's actually less than that, 7.7 times. So we do the same thing, sales divided by average inventory, and we get the ratio. So let's see how we can get this in number of days, which is how long it takes us to issue an account receivable and then convert it into cash. So the days sales and receivable is an estimate of the length of time the accounts receivable have been outstanding. With credit terms of N30, the days sales and receivable should be about 30 days. It's computed as follows. We have the average accounts receivable divided by average daily sales. So the average accounts receivable, again, beginning plus ending divided by 2. Average daily sales is the sales divided by 365 days. So using the same example, we're going to do the math here, and for year 1 it was 44.5 days. In year 2 it's 47.3 days. So you can see there's slight decline in this ratio, because 44.5 is better than 47.3, but it's not too bad. It's not like something that should be like too concerning for the accountant of the company and for management. Yet again, if the terms are usually 30 days, then you wish that this ratio would be closer to 30. So again, I think this is a very useful ratio. I think it helps you understand the length of the accounts receivable cycle, and accounts receivable is a little bit dangerous, because businesses, they want to make sure that they collect it on time and their customers don't default. So that's why it's an important ratio that most managers are interested to know. So here we have just a comparison of these accounts receivable turnover, and you can see here it was 8.2 compared to Columbia Sports, which is competitive or comparable company, was 6.5, and for year 2 is 7.7 compared to 6.9 for Columbia. And I think this shows that that Under Armour is actually doing better. The number of times they collected is higher than Under Armour, and that's also reflected in the number of days. So you see here that Under Armour was 44.5, and now it's 47.3, but for Columbia it's 56.2, and actually went down to 5.29, but still higher than Under Armour. So I hope this was, again, informative. Please study hard and let me know if you have any questions.